So we're in more of a trend market here than we are a momentum market, which says, look, we can be more patient and deliberate about where we look for opportunities. So in a momentum market, you have to be a price taker. You can't sit around and wait for things to pull back or feel comfortable with it. It's actually very uncomfortable to kind of push your chips into the middle as that's taking place, because you're buying strength. You're buying things that are usually making a new high, but that works in that environment. When you transition to a trend environment, you don't necessarily have to do that, though we still lean towards relative performance. We'll also look at things like what we call our optimal entries, right? These are oversold conditions in uptrends. We do that on a quantitative basis. And those are just, the opportunity not to have to pay up, not to have to chase momentum, but let the market kind of come back to you and own those things that are more opportunistically driven.
RenMac Off Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice, because it's not. Here we go.
All right, welcome to RenMac Off Script, where they openly discuss markets, economics, policy, history, and life. It is Halloween, Friday, October 31st, 2025. I'm Aaron Rodgers.
I'm Jeff deGraaf.
I'm Neil Dutta.
I'm Mike Santoli.
I'm Steve Pavlick.
So I thought we were doing costumes today. We're not doing costumes?
Well,
Hayes the new guy?
Can you throw a pick six?
I was just saying I should have done the Aaron Rodgers a la the Jets, but trolling the Jets fans at this point would probably be a bad idea.
It's a fair idea. Like, I'm going to go as 6. My wife's going to go as 7 this year. I think that's going to be, our jam. Neil, what are you going as? The invisible hand. Is that what it's going to be? Adam Smith's invisible hand?
Do you think that kids in China are finding entertainment out of the number 6-7? Like, do you read it? I mean, it's like one of the most ridiculous things. I mean, it is no joke. It's the word of the year.
It made the dictionary, right?
Yeah. Yep. 6-7. How about that? The power of social media. Well, listen,
wait, I want to know what everybody's going as. Mike, what are you going as?
Oh, sorry.
I got nothing.
Oh.
I'm so boring. I'm actually a little bit of a Scrooge about Halloween. So
you're maybe you just like walk around with the Daily Post under your arm with a pastrami sandwich and a Yankees hat.
Yeah. Just walk around with an actual newspaper and just be like an archaic version of a media guy. Yeah.
Pavlick, you going as Franklin?
Yeah, help wanted sign.
I actually was thinking for you, I hope you do this because it would be great. I hope you are passing out payday candy bars down in DC.
I hadn't thought about that. That's a good idea. Now, my son's obsessed with dinosaurs, so I'm going to be a dinosaur along with him and his younger brother.
Please send a picture of that so we can put it on the podcast. No, I am not Aaron Rodgers, but that is Mike Santoli. Mike, thank you for joining us.
Glad to.
I don't think you necessarily need an introduction, but I'm going to give you one anyway. So Mike Santoli is an award-winning journalist covering Wall Street for over 20 years. Investors, Dealers Digest, Dow Jones, Barron's, Yahoo Finance, and of course, now he's on CNBC. He's a fixture on CNBC's Closing Bell and Closing Bell Overtime. It is your 10-year anniversary this month at CNBC. Is that right?
It is my 10-year anniversary of being actually full-time on staff at CNBC. I've been kind of in the orbit of CNBC forever. And in fact, it's over 30 years I've been kind of doing this stuff. And sort of various contributor arrangements back into the late 90s. But yes, 10 years actually here. With dedicated gig.
Can I say something? When I was a junior in college, I was interning at Barron's at the World Financial Center for Gene Epstein. No relation to Jeff, but noted libertarian nut job. And
Absolutely, yes. The economics editor back then of Barron's.
I mean, I think he basically spent every week like trying to crucify Paul Krugman in his weekly column. That's basically
I
what
have
he.
so many stories about Gene that have nothing.
But I
so
remember running into Mike Santoli as a
that's crazy. Yes.
as a college student in the halls of the World Financial Center. So that was cool. He probably doesn't remember me though.
I mean, I don't think I do. I'm kind of disappointed I never made the connection before in my head. Gene used to be very good about getting kind of smart people in there to do his legwork. And, I was actually thinking about Gene, pretty recently because he wrote a cover story that was basically called like, Where Have All the Secretaries Gone? And it was about structural changes in labor markets and how, the job function of the receptionist and the secretary had been this long-term decline. And he just had a meeting with like some old Wall Street guy who was perplexed that his younger colleagues just didn't want to have a dedicated receptionist or weren't permitted to, and voicemail was displaced. Anyway, he made a big economic story out of it. And I feel like it's kind of relevant again as people talk about the job functions that are going to be displaced by AI or whatever else.
What I remember about that internship was that I was so desperate that I took something that paid me literally $10 a day.
How is that possible?
Wow.
I mean, it got me lunch downstairs. I mean,
yeah.
Barely.
Well, it can get you a latte now. So congratulations.
So Mike, just real quick, you started out at Yahoo Finance and then went to Barron's?
No. I was at Barron's for 15 years before that.
Oh, wow.
So
Okay.
I started out in the financial trades in the early 90s. I quickly went to Dow Jones Newswire. So I was covering, Wall Street, securities industry, et cetera, in the early to mid 90s there. Then went to Barron's. I was there for like 15 years and jumped to Yahoo for 3 years in the interim there when they were trying to become the free Bloomberg or something. And then I was a contributor to CNBC, and then I came on staff here. So that was the biggest single chunk of my career was at Barron's.
Well, I will tell you, this is no joke. I remember you took over for Alan Abelson, I believe, and
I was sort of alongside Alan, but yeah.
But I would subscribe to Barron for no other reason than to make sure I saw your column on Saturday. Again, just as kind of a backstop to like, did I miss anything? Because you've always been so good at just kind of picking up the buzz on the street, and I really appreciate it. So it's
nice of you to say. I look back fondly on the days when I had a week to sort of like boil it all down and synthesize it and come up with a take or something. But yeah, but it's interesting because Barron's had that profile forever. We own the weekend, and we had sort of the Saturday read that's sort of gone away. They've had to adapt, but it was a great place to be. It's interesting though, because of the culture of Barron's, and you talk about Alan, and just beyond that too, was self-styled contrarian value sort of approach, not exclusively, but that's sort of how it. I sort of had to kind of retrain myself out of that a bit. You have to. So I would say that since then, it's been a project of like increasingly listening to the market rather than insisting on what it should be doing and that sort of thing, and being open-minded about where things can go and the limits of valuation.
Well, Mike, that's probably a great place to jump off. I mean, obviously, you read a lot of research, you talk to a lot of investors. What's top of mind for people? What are they most concerned about, or scared about, or talking about?
I mean, I would say it's very similar themes, which is there's a respect for the strength of the bull market, kind of diluted a little bit with unease about the same old things, which is a very concentrated index. Nobody feels like they own enough of the stuff that's really up the most. And then a little bit of, I find a fascinating debate, Neil's right in the middle of this, of like, the underlying economy is kind of like decelerating or showing some cracks versus a really vocal camp of like, we're spring loaded to reaccelerate here. So I find that parts of the market that have been getting the most attention are the ones that are kind of almost separate from the here and now macro, right? So whether that's AI Mag 7 or it's kind of zero fundamentals, low quality speculative stuff, Now, I know, just been pointing out that cyclicals over defensives has still been kind of in a decent trend, and that's reassuring. But I feel like those are the things people are most fixated on. I don't think there's as much of a Fed obsession, despite the little wrinkle we got thrown this week, as there was, I think, just because of the overwhelming brute force of the AI story.
Well, Neil, why don't you talk a little bit about that wrinkle? I mean, obviously we had the hawkish commentary. I think the mortgage rates have actually gone up, not down. So that's not helping much, right?
Yeah, I mean, I think you could characterize Powell, this was sort of a hawkish cut. I mean, he went beyond the standard kind of boilerplate about policy not being on a preset course, right? By basically saying that December wasn't a foregone conclusion. Far from it. Those are his words, not mine. So he sort of, I mean, to me, it feels like they have a bias to do nothing in the absence of additional data coming out. And, you look at, right now, the hawks are squawking. I mean, I saw the guy that dissented at the October meeting. He's out there today talking about why he dissented. And then you had Lori Logan. She's at the Dallas Fed, but she's also basically making the point that, it doesn't really make sense to cut in December because they took out all the insurance they needed to in September with their rate cuts. So you have the hawks squawking, you have Powell kind of leaning into this hawkish cut, and promptly mortgage rates shot up, and we're basically at 3 or 4 week highs on the 30-year fixed rate mortgage. You probably put the housing market back into the penalty box at least through the rest of the winter, in my opinion. Not that it was really out of the penalty box to begin with. And that's a problem because, that's really where the risks are. And I don't know. I mean, I've sort of characterized the economy as three things, right? You have this AI boom that's ongoing. We all know about that. It's spectacular growth driven by, capex. Then you have the consumer, which is hanging in there. And then you have housing, which is clearly in recession. And the question is, I think, at what point do builders say, it's hard to make things work and we need to start letting go of some of our workers? I think we're getting closer and closer to that point. You look at some of the builder commentary, they're having trouble moving product, even though they're buying people down to like high 4% interest rates. Like that to me is problematic. So that's kind of where I'm at. There's a lot of enthusiasm around consumption. I would just say that consumer spending never gives you the signal, right? There's never been in the long history of business cycles, there's never, ever been a time when consumer spending has actually declined in front of the bad thing, of the economic slump. Sometimes consumer spending actually expands during a recession. So, I don't know that consumption is the signal we want to look to. It's usually on the investment side, typically residential investment, not business investment. So, the truth is that there's never really a great economic indicator that kind of tells you what's going to happen. That's sort of the nasty little secret about people in my business. They try to, kind of say that we have these leading indicators. There aren't really any leading indicators. To me, the housing market is a problem, and I think it probably gets worse before it gets better.
So real quickly though, you've got Fed funds futures now that we're pricing in 90% chance of a Fed cut in December. They've come down.
Yeah, we're at like 2/3 now. And as I said, I could see a scenario where, you get some hawkish squawking, maybe the trade's up to 50-50 by the time you get to the meeting. I mean, it would put further upward pressure on interest rates. And we'll see. It depends, how much data they can start rolling out after the shutdown is resolved.
From the market's perspective, it's interesting because home builders, not all of them, there's certainly been some that have undercut their lows, but the building product names are the ones that are really the weakest. If we look at those charts and look at top formations, those are substantially weaker than what we've seen out of the home builders themselves, which I don't exactly know what that means, but just a takeaway from what the charts are saying.
Well, home builders, their margins have been getting squeezed as they've been selling these houses, essentially by buying people down on their mortgage rates, right? So the higher mortgage rates are, the more they have to give up to buy them down. And what does that mean? They have to squeeze their own costs, and they're going to have to do that on the back of their suppliers, which are like the building product companies that you just mentioned. So, and it's also probably just demand weakness from weaker construction on the residential side. So, yeah, there's not a lot to like in construction. And yeah, I mean, I think it matters. I mean, to me, as like a US macroeconomist, like I'm very open about my process, right? I mean, I'm basically telling our clients that I think housing and labor matter more than AI. And you can either agree with that or not.
Mike, do you agree with that?
I mean, I think that's the interesting push-pull. I'll tell you the things I hear from a different direction on what might be a mitigating factor is everybody has got their number for first quarter, bump in tax refunds for individuals, 150 billion, whatever it is. And so there seems to be this kind of like, gain after pain, at least in the short term. And, I think that it's not wrong, the general sense out there of like, okay, it's a little bit more of a asset-based, wealth effect-driven capital over labor phase that we're in right now. So I don't know, ultimately, I think what we benefited from the markets was that because the Fed focuses specifically on labor market indicators, or supposed to, that when they softened up, that opens the window to a Fed rate cut, and then you were able also to say, but you know what, structural factors and other things mean that the labor market's not fully reflective of the GDP trend, so we're getting the benefit of a dovish turn in the Fed without having to actually have that high risk of a recession or an outright downturn. Now, I think that's where the debate is, of course, as Neil's kind of saying right here. I always go back to the old ad tagline from the Cosmopolitan Hotel in Vegas, which was just the right amount of wrong. And I think the market kind of like, it loves that environment where it's just kind of like, look, mostly it's good, but you have to have something in there to give you a little bit of a sense of slack or room for improvement or something.
Mike, do you have the address of that hotel?
I've stayed there. Yes, but I think it's probably like an old man hotel by now. It's like 20 years ago.
It is. You could stay out there. They had the Sunday recovery, I think, right? That was a big party, right? We stayed the Sunday night. I'm not sure that was much of a recovery. Jeff, go back to the markets for a second, because Mike was talking in the beginning about sort of, trends and momentum and whatnot. You had a 6,800 target as we started the year. Congratulations to you and your team for getting through that. But talk a little bit about what you're seeing in terms of trend versus momentum, because there is a distinction right now.
No, yeah, no doubt about it. So, trend markets are kind of path of least resistance, right? You spill water on the table. At some point, that water is going to find the way to get on the floor, right? And that's kind of meanders. There's nothing urgent about it. It just kind of finds its own way through gravity. And markets are the same way, just obviously opposite as they ascend. So momentum is really kind of the concentration of a high percentage of names acting in the same way and doing the same thing, basically going up in price. And there's a lot of different ways that you can measure that. I mean, one of our favorites that we developed is the percentage of issues making 20-day highs at any given point in time. And when that number, exceeds 50%, you're basically money good for the next 6 months. Curiously, this triggered back in, I think it was May. Or late April of this year. So we're right in that 6-month window that you can, I think about it exactly like a shot clock, right? Give me 20-day highs above 50%, and I've got 6 months to make money. And if it doesn't, reoccur, then it's not that that's the top and you're done, but then you get into kind of a market that it's 2 steps forward, 1 step back, 3 steps forward, 2 steps back, and then you can kind of transition how you want to play. So in a momentum market, you have to be a price taker. You can't sit around and wait for things to pull back or feel comfortable with it. It's actually very uncomfortable to kind of push your chips into the middle as that's taking place, because you're buying strength. You're buying things that are usually making a new high, but that works in that environment. When you transition to a trend environment, you don't necessarily have to do that, though we still lean towards relative performance. We'll also look at things like what we call our optimal entries, right? These are oversold conditions in uptrends. We do that on a quantitative basis. And those are just, the opportunity not to have to pay up, not to have to chase momentum, but let the market kind of come back to you and own those things that are more opportunistically driven. Now, part of the problem with that for people is that they'll say, well, is Oracle an optimal entry? I want Oracle to be an optimal entry. It's like, no, that's you can't play this that way. What you have to think about, optimal entries are exactly like walking the streets of New York, trying to make a living picking up $100 bills, right? Like that's not going to work. But if you see one when you're walking down the streets of New York, you pick it up, right? And that's exactly what they are. So you can't kind of force, I'm going to go down 57th Street and there's going to be a $100 bill and I'm going to pick it up. That's not the way it works. It's like, I just happen to be on the Lower East Side and, here we go. And by the way, that's probably a $50 bill down there, not 100. But either way, that's kind of how we think about it. So we're in more of a trend market here than we are a momentum market, which says, look, we can be more patient and deliberate about where we look for opportunities. And frankly, a lot of those are not going to be the Mag 7. They're not going to be kind of the popular names. They're going to be names that have been in good uptrends and have pulled back recently and now look like they're at a point where they're going to start to reassert their trend, not their momentum, their trend, which is the upward bias.
Does breadth and/or credit, what you're seeing there, concern you? Or I'd throw this one out to Mike as well. Do either of those really concern you?
Yeah, I want to hear Mike's take on credit. I'll talk a little bit about breadth because there was I don't know what it was, an article. I don't know if that's fair to say it's an article. It was in Seeking Alpha or something. I'm not sure what it was. It talked about the worst breadth we've ever seen in history or historical breadth. And the problem, I 100% disagree with the assessment of that. Now, I understand what they were doing and how they were looking at it. It's kind of a point in time analysis, which is not the way that you should measure breadth. Breadth is really the trend, again, the path of least resistance. And I think a very simple way to think about breadth is if the Russell 2000 is in an uptrend, you probably don't have a breadth problem, right? In other words, the majority of stocks, 2,000 names, that's not the Russell 3, but the 2,000 names, a small cap, if that's in an uptrend, you probably have a pretty decent breadth environment. That was not the case in 1999. That was a historic breadth divergence where it was only a very small portion of the market that was actually moving higher while the rest of the market was moving lower. The breadth problem that a lot of people have had in this market is that there's a small percentage of names that are outperforming, even though a lot of the other names are still going up, but you're just not keeping pace with the market. And so that's more sour grapes than it is really a structural problem. So I worry about if you've got, banks and you've got staples and you've got discretionary and you've got industrials actually losing money, that if you hold those names, you've got less money today than you did 3 months ago. And yet tech is making a new high and the market's making a new high. That's a breadth problem. The relative game is just, it just happens. I mean, that's the way the markets generally tend to work. There are winners and there are losers, and they focus themselves or express themselves that way. But Mike, what are you seeing? I know we had a conversation maybe 2 weeks ago about credit. What are you seeing in
Sure. Well, first, I'll just mention that point in time indicator you were mentioning was, it was the most negative breadth within the S&P 500 on a day when the S&P itself was higher. And to me, we've had a great frequency of those types of readings, and it's strictly downstream of how concentrated the market is. I mean, there were millions of times in the past where I'm sure you had 350 S&P stocks down, but there were 4 or 5 really important stocks that were up. Those 4 or 5 just didn't represent 30% of the index. And so, what are you actually saying? We know that this is the market we have. And if the whole market was down 60 basis points on a day, you wouldn't say there was anything concerning about that. So I'm with you on that, although that is, again, kind of this wall of worry. We're not keeping up. I would also point out 1 year ago, I mentioned this yesterday, there was a parade of folks who are guests and professionals in the business who would say, look, you got to stay in the market, but maybe next year's the year to just rebalance into equal weight S&P. Right? I mean, it was a very popular idea because that's your answer to your clients. You say, isn't the market expensive? Isn't the market too concentrated? Well, you're kind of lagging by like 900 basis points or something year to date if you are equal weight. So I think that's where that frustration piece comes in. When it comes to credit, the publicly observable credit metrics, as you also often point out, are totally fine. And they suggest, and then if there may be a timely, if not like super long lead indicator, then I think you could say there's not a lot of macro stress that's observable out there. Now, the private credit piece of it, I think people they're kind of over extrapolate because they remember the trap from the financial crisis. And just in the same way that people remember or have read about the trap of believing that the NASDAQ, going up when everything's going down is a problem from 99. So, I think private credit, one reason it's a sore point is not just that it's a little bit opaque and it's obviously a little bit lower quality. You're seeing a higher default rate in some of these weird one-off structures lately. It's because I think people are uncomfortable with how fast it's grown as a category. And let's make no mistake, this is a product being sold and not really desired in large part. I mean, initially it was a very elegant path through regional banks cutting back, and the public debt market's not always not being for everybody. You get these bespoke loans and you can have higher returns. But I think it runs into this problem with so many asset managers have skewed in this direction because that's where the fees are, and they can say it's non-correlated, but that just means it's not really marked every day. And they could say that it's we're hands-on and we can manage through these default issues, but in reality they're takers of assets, they're takers of loans. And I ran into somebody at one of the second to third tier credit rating agencies, and he was saying, we're so busy because insurance companies, they just want to make some loan to some mid-sized industrial company, and they'll call us and say, hey, this company wants you to rate their debt. And they'll say, okay, we'll give you a rate. So that sounds like it's uncomfortable and it's a potential for danger there, but I don't really see it happening. So again, I think that the problem is private credit as a product feels as if it's being pushed on people. And I do think it runs into the why am I so lucky issue, which is hey, this is an asset class that gives you 8 to 11% when, public debt is just, and it's why am I special that I get that? What, tell me that's not without some kind of a risk. So I think that's where we are with it. And then on top of it, everybody wants to say, okay, AI is now a debt-driven story because of the data center construction, because Meta did a big issue yesterday. I mean, Meta doubled its long-term debt yesterday, I guess, with a $25 billion offering. I mean, it's trivial on the balance sheet. Meta still has $40 billion in cash. I think that their total interest cost is going to be a couple billion a year. It's nothing. But, because they're doing it, everyone wants to feel like it's level 3 and Nortel and Lucid again.
Right. Well, I mean, look, I think that there are definitely, and you know this as well as anybody else, there are similarities to every cycle, right? And that's one of the reasons we watch credit so carefully, is because a lot of things do tend to brew in the credit markets, at least initially, and that's a tightening of lender standards. And I always say, wherever the credit is growing the fastest, that's what you want to keep your eye on. Because I used to work with a Staten Island bank analyst. He was so great, and he was about my age, but he had the big accent, the whole thing. He's like, "You want growth? You want growth in a bank?" He goes, "Go out and go out with a sack of money on the corner and start handing out $100 bills." He's like, "You can grow. That's easy to grow. Now go out and get those $100 bills back. That's the hard part, right?" So
Right.
100%. That's the way. So when we look at it and you talk about private credit, clearly it became uber competitive, and I've got probably 6 neighbors here that can speak to that. The underwriting standards end up dropping because of that competitiveness. And then, marginal credits get financed, right? The covenants, all that stuff just gets, competitively pushed away because people want the business. So, I think we tend to fight the last war, and the last war was a big one, right? I mean, the last war was the nuclear winter of, mortgages, and it was in the banking system. You had the government mispricing risk with Fannie Mae. Obviously securitization was a new kind of thing that people weren't really familiar with. So, and then all that ended up being the collateral, right? Right now, I think you've got these episodic issues, some inventories, some frauds, some bank loans. In fact, a good friend of mine is actually on the forefront of one of these. He's like, essentially our collateral, when ICE came in and started doing raids, essentially our collateral went south of the border, with the cars, and, good luck on your recourse with that, right? We basically had to go down to El Paso and sit there as credit guys, making sure the VIN number wasn't on our balance sheet. So, I think it's easy to fight the last war, and I do think that credit will be some part of the mix of the next bear market. But looking at it structurally and systemic here, it feels at best premature to me. and maybe just a red herring. Now, I will say, and I don't know if you've seen this, Mike, and if you have, I'd love to get your comments on it. Which you have seen like Oracle CDS spreads start to widen. Obviously, the idea that they're going to need to pile on the debt and their debt structure is going to go up dramatically. I haven't done the math, so I can't remember what that kind of that ratio looks like over the next 5 to 10 years. But you're seeing pockets of it. But again, that seems to be getting priced, right? That's not a problem yet, but it's people anticipating maybe a problem, and they're pricing credit the way it should be priced.
Exactly. And I mean, I always look at CDS as sort of it's kind of it's the hedge, right? So it's kind of like, yep, we're going to absorb the paper. You maybe want a little bit of a safeguard against it. And I think there are going to be issues that people are now trying to kind of bring forward, which are, look, these actual NVIDIA processors are fast depreciating, and whether they should be or not, they depreciate quickly. And so are we just on this treadmill where we just have to keep plowing comparable amounts of capital into it? The other part of it that's not so much about some big glaring risk, but that is fascinating to me, is that the whole investment thesis around that category of companies, the Mag 7-ish companies, went from these are magical free cash flow machines. They never have to really reinvest. It's just network effects and it's an app, to they're building as many boxes in the desert as they possibly can and are generating their own power for it. And they're no longer asset light, and free cash flow has gone away. And, so if you look at like the free cash flow yield of the NASDAQ 100, it's crashed, right? So it's like, but the market's okay with it, right? So the market right now is telling you, fine, until further notice, we're going to assume that the return is going to be there, or it's just fattening up the food chain so much right now. And there you have NVIDIA on pace to do like $250 billion in free cash flow. So it's taking all the free cash flow from everybody else, and then it's now reallocating it where it sees fit. So anyway, I feel like that's the backdrop, and it's maybe encouraging that they tighten the leash on Meta a little bit and say these guys seem like they're kind of a little less careful and more desperate or whatever. Not that it was disastrous for the stock, but it definitely showed you that it's not an open-ended blank check for everybody.
Hey, speaking of that, Neil, I think you had a report out this week to our clients about sort of what we're seeing in the smaller business end of things in terms of credit. I want to get to Steve in a second because Pavlick's at least a guy working down in DC, so I got to put him to work. But before we get to him, are you seeing that in small businesses?
I mean, we don't have much data to go on, but if I look at credit conditions among NFIB members, you do see that more of them expect credit conditions to tighten in the future. So that's more of them reporting that credit's harder to get. And I think for them, think about their private sector borrowing rates. Like the actual interest rate paid by on short-term loans by small businesses, if you look at the NFIB survey, is around 9%. And that's probably going to go higher now that rates have backed up a little bit. So yeah, I don't know. I mean, that seems like a very challenging environment to make the math work for a lot of small businesses, especially considering, nominal growth in the areas where they do. I mean, a lot of them aren't participating in this spectacular AI boom, right? Like, so nominal growth in their part of the economy is a lot weaker, right, than what it is probably for the overall economy. So, I think that to me, that's an issue. I mean, if the interest rate you're paying is higher than nominal growth, math becomes more challenging. It's just that simple.
Directionally, that survey, obviously is pretty helpful in terms of how it's changed over time. But one of my favorite things about that survey is that literally in the entire history of NFIB, you've never had more respondents say that they expect credit to get easier than harder. Right?
No, that's true. It's directionally that you want to pay attention to it.
And like 70% of the members are like 10 employees or under. It's like super, super small business. So I find it's totally illuminating on the trend and the hiring intentions and all that stuff. But I just always got a kick out of that, where they're always like,
it's
the
always
bank
below
knows
zero.
this.
No, you're right. Yeah.
So Steve, Your thought? Lots going on in DC despite people being out, right? Nuclear's back in the news. You got House of Dynamite on Netflix, which if you're not working at the Department of War, I think you think it's a good flick. You got maybe testing coming back since 1992, and of course Trump's talking about we're putting pressure on the Senate to get the nuclear option. Do we care?
I care more about what happened not in D.C. but over in Asia. I mean, that was the big story, I think, this week with China. You're the one dressed as a football player. You got a punt, and it was a longer punt than I think many had anticipated.
Now when you throw interceptions, you don't. You don't punt when you throw interceptions.
Well, I guess that was the fortunate thing. We didn't see Trump throw any interceptions there with respect to, Taiwan or making major concessions on NVIDIA Blackwell chips. I think the NVIDIA story is probably a reflection of divisions within the administration. You have hawks that don't want to aid China in their AI aspirations by giving them access to sophisticated semiconductors. And then you have people that are more sympathetic to Jensen Huang's goal of making China dependent on U.S. semiconductors, maybe just not the most sophisticated. So I think that's why Trump was sort of, we'll sort of let China and NVIDIA negotiate this moving forward. So, I think the thing that I actually took away were the conversations leading up to the meeting with Xi. That was an attempt, I think, to really strengthen Trump's negotiating leverage. You go back to what was announced. We saw the typical things with respect to what do we export. It's agriculture, it's aerospace, Boeing, it's defense. We're selling a lot of weapons. It's agriculture. Part of that's to reduce dependence on China for soybeans, and it's AI. So that's sort of a theme that we've seen throughout. But when you look at Southeast Asia and the announcements there, that was really important in terms of including these clauses on respect to transshipment, China's ability to circumvent U.S. trade restrictions. And if the U.S. can actually get these Southeast Asian nations in particular, like Vietnam, Malaysia, to come on board and force this, that's really going to strengthen our leverage moving forward. You also had an announcement with Japan. You saw it with Malaysia. You saw it with Australia just before Trump went over there. That was meant to reduce our dependency on China for their pun intended trump card on their rare earth restrictions there. So moving forward, that's going to be really important. I think the thing to remember about rare earths, despite the name, they're not rare. It's a processing. That's where China has the monopoly. That's where they have the choke point, and that's where strategically the U.S. needs to reduce that moving forward. So directionally, I still see this path towards divorce. I just think maybe the pace of getting there is going to be extended until the U.S. can rely more on its own capabilities to produce rare earths. And, China's trying to do the same thing. They want to reduce their dependency on us for the semiconductors needed to their AI. So whichever side can sort of win that race, I think it's going to have more leverage moving forward.
Can we see other people while we're getting divorced, or are we still strictly monogamous in this relationship?
Well, I think Trump's looking around, and that's probably might not come as a surprise to some, but it's where we get these other alternatives. I think we used the analogy before that U.S. and China are similar to a couple that's agreed to separate, but they're going to remain in that same house for a little bit longer to minimize the economic disruption, maybe because they have a sub 3% mortgage. And I think that's where we are. We're trying to prevent this mutually assured economic catastrophe. But, over time, I think that's where we're headed. And the thing that's scary, you mentioned the Department of War, is countries that trade together tend not to go to war against one another. And as we sort of reduce our trade with one another, I think that's sort of the fear longer term. And from a U.S. standpoint, it's how do you reposition the military for what you may foresee as this inevitable conflict with China.
How long till we can get our rare earths,
It's 2 years.
Oh, is that all it is?
The only reason I know that is because Doug Burgum was on an interview yesterday, and they asked him specifically, how long is it going to take? He said, talking to people, he hears it's 2 years. Now they're hoping to accelerate that, but that's sort of the timeline that he suggested yesterday. He knows much more about this than I do, so I'm going to go off what he has to say.
Is that with or without Greenland?
One thing that I recently became aware of, and probably a good answer to why there hasn't been a lot of investment in rare earth capacity elsewhere, is the aggregate dollar value is trivial. It's really not a big business. It's not that attractive in terms of, putting the capital. So therefore the government kind of has to just stoke it,
No, you're absolutely right. And part of the problem is what China's done. They've taken years sort of anticipating this. And so whenever there becomes a competitive processing market, they just subsidize it, undercut the pricing, and force them out. And I think to your point, Mike, that's what the strategy is moving forward, is guaranteeing a price floor, guaranteeing future buys, and trying to incentivize that. Now, I don't know how you can really evaluate that. And I think, talk about what do these partnerships with other countries and suppliers mean. I think if we're talking about identifying where these processing capabilities are going to be, my guess is they're probably going to be outside the U.S. just because you're probably going to have to go somewhere where there's just fewer regulatory hurdles, because they do emit a lot of pollution. And, while Trump is trying to do what he can on the federal side of the regulatory environment, you still have a lot of states here that are going to pose a problem. So when you look at something like this potential American bloc with an agreement with Canada and Mexico, this is an area where I think you could see this maybe come to fruition. Canada has a big supply of rare earth materials. You could probably process them in Mexico, again, where the environmental standards aren't as stringent as they are here, and perhaps that's where we get to at some point.
All right, let's move to the mailbag. Harry, good morning.
So today our question come from Kush Saxena. And his question is, we know there's a fundamental disconnect between the state of the consumer hurting and the broader industrial economy seemingly booming. As we look forward, what's good macro indicator or metric to keep an eye on that represent a decent nowcast or real-time sense of whether the consumer situation will get better or the malicious of the consumer economy will eventually slow down the industrial economy? Thank you.
Well, Kush, while they're deciding how to answer that one, I'll remind you that I'll get you a nice RenMac trucker hat out to you for that submission. Appreciate that. As people that listen to this podcast know, if you can submit questions, we'll get you a trucker hat, maybe some golf balls, maybe who knows what we'll get you. We'll get you something. But thanks for getting onto our social media platforms and submitting those questions. So there you go. It's a tug of war. Who's going to win?
Well, I don't know that that I necessarily accept that the industrial economy is booming. I mean, certainly Caterpillar is booming. A lot of that has to do with the AI data center build out. But what part? I mean, you look at things like freight as an example. Freight, I don't think you could say is booming. I mean, that's an important part of the industrial economy. I was looking at rail car loadings earlier this week, and they're actually down about 5 or 6% against last year. Typically, they go up during this time of year, right? Because you're kind of getting ready for the holidays and so forth. So, I'm not so sure that the industrial economy is booming. I mean, we've continued to see ISM running below 50. But in terms of there's always this desire for the hot macro indicator. Jerome Powell put a lot of weight behind initial unemployment claims this week. He mentioned that, I think, no fewer than 4 times in his press conference this week. And I think it's pretty interesting and revealing because initial jobless claims, in my opinion, aren't really a leading economic indicator. They're just an indicator that happens to be released every week, and that's what makes them good. But it's not necessarily leading. By the time initial jobless claims tell you something, that's it, folks, right? So, I don't know that there's a good indicator. I don't think that there is a holy grail indicator. That's one of the reasons why I do what I do. And I don't to me, the thing you want to keep an eye on, if you're trying to use the economic data to make a big economic call or market call, is really you want to look for, if you get a string of 150,000 jobs, and then all of a sudden you get 50 or 0, right? It's that kind of, if things are okay and then they're not. That kind of what looks like sort of an idiosyncratic event, that's what you want to keep an eye on. That's kind of the old sort of Alan Greenspan look at it.
Isn't that what we got this year? more or less?
Yeah, I mean, in some respects, then you have a lot of rationalizing away of it because of immigration and so forth, right? I mean, if you were going into the year, Mike, and you told someone, that we're going to have negative jobs growth at some point this year, I mean, I think most people would not have come back with 6,800 on the S&P 500, right? But that just kind of tells you about this sort of where people. I mean, there's a lot of the economy is basically innocent until proven guilty because of what's going on with the stock market, right? Like, so that creates a potential risk down the line. I mean, I've always said, the process I've used has been consistent since the pandemic, right? Like it's incomes, housing, government spending, and just how people are thinking about the world, right? 3 years ago, incomes were rising, housing was fine despite rate hikes, governments were spending money, everyone was thinking there would be a recession. That's why I said there wouldn't be one. Now you pull this same analysis forward, incomes are slowing because of the labor markets, they're slowing. Housing, even though the Fed cut 100 basis points last year, housing is worse now than it was a year ago. Governments are, very publicly not spending money, not just at the federal level, but also state and local. And what is the implied recession risk in the economy or in the markets? Like less than 10%. Like, so no one's really expecting a bad outcome. So, that's the process that we're using. I wouldn't necessarily. I would say to Kush, we don't have an indicator, and I would say that the indicator that you hear the most about, which is initial claims, that to me is like episodic, right? When by the time it tells you something, it's over. It's over. So why pay attention to it?
Well, Kush, we'll get you a hat. Thanks for being a listener to our podcast. Let's go around the horn as we close out here. Things that we're watching this week. Steve, I'll start with you down in D.C. Are we ever coming back to work?
I think we might. And the reason I'm saying this, we're recording this Friday. It's Halloween. Things should get scary for lawmakers starting tomorrow, November 1st, in the sense that Democrats hope Republicans will feel pressure when the letters regarding people that participate in ACA health insurers start to go out, alerting them of the premium increases. Republicans hope Democrats will start to feel some political pain when SNAP recipients don't receive their full benefits there. And you really need some political pain to really force this movement. It's been as absent so far. Things contributed to the length of the shutdown, which will reach its longest ever next week. And so then you look ahead to Tuesday. That's the elections or state elections. And there's a lot of emphasis, and people always watch what happens in Virginia and New Jersey, the gubernatorial contest there. And look, historically, the party that doesn't control the White House performs well in those states. Kamala Harris won both states by about 6%. Polls show Democrats favored there. So the reason I'm bringing that up is from an electoral standpoint, I wouldn't read too much into it in the sense 4 years ago, Republicans overperformed the election. Then in the midterms the following year, Democrats overperformed. And then in the 24 election, we had a Republican sweep, where I think you're looking at the impact for the midterms. Watch California. There's a Prop 50 ballot that would allow them to draw 5 more Democrat-leaning states. That's in response to what Texas did, trying to drive 5 more Republicans. It's really difficult to handicap the House right now. We don't know what the map's going to be. But the reason this matters for the shutdown is neither party's really incentivized to make a major concession until after the election. They don't want to jeopardize their bases there. So we may start to hear some positive talks to resolving this by the end of next week. My guess is it's probably going to take an additional week just to paper the deal, get both the House and Senate back to agree to it. You have the added complication of probably needing to extend this stopgap date from November 21st, something being debated either from this December to the following December, probably somewhere in between. So that's something to watch. And then the other thing I would watch next week is Wednesday. That's when the Supreme Court is going to hear opening arguments regarding President Trump's ability to impose tariffs under IEEPA. That it accounts for most of the revenue that we're receiving right now. That is the trafficking tariffs for both Canada, Mexico, and China. It's also for the reciprocal tariffs imposed on other trading partners and the universal baseline. So my guess is we'll probably get a decision by the end of the year. I think that's the expectation. If the court doesn't rule in the Trump administration's favor, tariffs are here to stay. They'll probably just use other authorities. I think that's why you haven't seen markets really moving too much on this. I think it's also why you continue to see other trading partners still move forward with these deals despite the uncertainty there. the thing to watch in the decision, if we get it, if the court rules that the administration did exceed its authority, is will the government owe damages? And if they do, you could see some potential cash windfalls. And then companies may have to decide what they want to do with that, and what the timeline is going to be for them to receive that. So that's what we're going to keep an eye on for next week.
Plenty to watch. Neil, what's on your radar?
Yeah, if someone believes that Trump is going to let the SCOTUS pull the tariff lever, I think they should be seek a psychiatrist.
He may attend, and that would be.
I mean, the problem is that Congress has created a vast legal architecture from which the president can prosecute a trade war. I mean, you can come up with a fake study and just say, yeah, it's a national security threat, and then you just slap the tariffs on everyone individually. I mean, it's a bit of a joke. You know, the real escape hatch isn't the Supreme Court, it's Congress. Anyway, in terms of the data, it'll be ISM and PMI week next week. So we get ISM, markets looking for 49.2. I think keep an eye on vehicle sales. I think vehicle sales will probably sluggish in October. And then we'll get ADP, the employment report everyone jokes about until it's the only one that they got. And and then we'll get ISM services and the UMISH data. It was going to be payroll Friday, but we don't have payroll Friday, obviously. So,
Jeff?
I mean, you've got the mayoral election, right? How do you not want to, I guess maybe it's a foregone conclusion, but that'll be just fun fireworks. You know, we're watching, I think there's a couple interesting things. This kind of disconnect, you've had some of the high flyers, particularly the microcap names, you know, the quantum computing names, some of the rare earths, some of these names have, I don't want to say come back to earth, but they've certainly had, you know, pretty significant drawdowns. They're not oversold yet. So we'll be watching for that. Same thing with gold. Obviously, the gold contraction has played out in our favor, but again, not yet oversold. And that'll be interesting because in uptrends, oversold conditions hold. In downtrends or after peaks, they hold temporarily, they rally, and then they roll back over. So we're not there yet, but we're getting into this kind of pivotal point on what does that look like between the remainder of the year and into 2026. If those oversold conditions hold and they respond vigorously, that's really good news for the market and and where we're likely to play out for 2026. So I'm watching that, and then the percentage of issues above their 200-day moving average has been softer. Again, not a big problem for us, but it does imply that this is more of a trend versus momentum market. But you don't want to see that really weaken. You want to see that, continue to kind of stay where it is, and then start to accelerate from there. So if we get 20-day highs, that start to expand, all that's good news and sets up bullishly. We haven't seen it yet, but again, we're not oversold enough yet to expect that to start happening. But that's what I'm looking for.
And Mike Santoli, you get the closing bell.
All
See
right.
what I did there?
Yeah, I mean, I would just build on that and say, like, the revealed character of the market next week is what I would probably focus on in terms of, whether it manages to kind of hold this very elegant rotational type action, even on days when, Mag 7's for sale, other stuff has kind of come together structurally to just kind of mitigate the damage. That's been the case. We had that 1 day air pocket really a couple of weeks ago, and that's when it kind of broke down. We're in this, I don't overfixate on this stuff, but we're in this one of those funny micro cycles where it's like the most bullish 5 days of the year or something from October 29th through the first few days of November. And so just, I'm not going to defer to it, but, assume that all else being equal, we should probably kind of hold together pretty well. And what's part of that is reactions to next week's earnings. Everyone kind of has this feeling right now, like, okay, the big stuff's out of the way. We've kind of rewarded and punished who we had to in terms of the big Mag 7 names on results, but you're still going to get the fuller run of companies next week. And sometimes psychologically, the bar gets raised and maybe they trade them off. So far, so good. I think, the market is not really making a wrong step. And I think I'm in that mode of wondering about how if it's just going to it has to build into further excesses or into next year or something before there's some kind of a sense that it gets more fragile.
Well, that's great, Mike. I really appreciate you being on our podcast this
thank
morning.
You guys.
Yeah, thanks, Mike.
I really appreciate that. I'd remind our listeners to make sure you're watching Mike on CNBC's Closing Bell every day on CNBC. I'd tell you to follow us on X, on Twitter, on our TikTok channel, on our YouTube channel. Reach out to RenMac.com if you want to see more of what we do here at RenMac that goes beyond what we're talking about. But we'll be back next week doing the same thing without Mike. But Mike, you're always welcome to come back and join us. So
All right,
we'll
let me
ping
know.
you. We'll ping you for sure. Until then, I'm Steve Duttenhofer.
I'm Jeff deGraaf.
I'm Neil Dutta.
I'm Steve
I'm Mike
Pavlick.
Santoli.
And that's Mike
guys.
Santoli.
See you, boys.
Thanks, man.
Thanks, Mike.
Thanks, everybody. Have a
Appreciate
great
it.
week.
Thank
See ya.
you.